Good morning. Welcome to Trading Hour. I'm Reema Tendulkar with Mia Pavitra Parekh and Surbhi Upadhyay, and it's a quiet Tuesday morning so far. The bias is negative. The benchmark indices are down, but mildly, just down close to about 0.1%. The Nifty lower by 20 points. The Sensex sees a cut of 60 points for now. The Nifty, at least, is exactly hovering around the 200-day moving average. So that's where it's been hanging around for the last 10-15 minutes. Not breaking below it, but not able to climb well above it. Autos are doing well today, so the Nifty Auto Index is the top sectoral gainer with a gain of about 0.8%, 0.6%. M&M is moving higher. Remember, the auto sales come out tomorrow. But apart from that, you've got green in the screen in the Adani Group names. So Adani Enterprises, Adani Ports are rallying hard. A couple of the FMCG names like Asian Paints and Titan 2 make it to the gainers list. But again, the gains are not too big, to talk about. You've got an Asian Paints up less than 1%, while Titan 2 is up close to about 0.7%. Mid-caps are holding up relatively better.
Relatively, yeah. But otherwise, as you said, it's such a quiet Tuesday, Reema, right? This market has absolutely no triggers. I mean, we're talking about a 100-point range on the Nifty, and it's all happening within that. The saving grace for the bulls, obviously, has been the fact that we respected some of these psychological levels yesterday. We are right now just about 20 points above the budget day low, and that's how things are holding. Very indifferent sort of cues, even from across the region. There's not much that's moving the markets beyond fund flows in the neighborhood as well. And fund flows, obviously, for us have been on the negative side. So we know that it is all about individual stocks, which is why you'll hear more of that as we go along on the show. You've got interesting reactions. A stock like Vesuvius reacting to numbers down about 11%. There is SpiceJet with of course, the Carlyle Aviation coming and picking up stakes. Some of their dues getting converted to equity. That stock's down about 6%. Uflex is trying to recover from yesterday's body blow. So it's just about individual stocks picking, those individual news points and then running with it. Apart from that, Pavitra, the market continues to be perhaps as directionless as ever.
Oh, absolutely. You really have to dig deep, right, if you want to look for some action. But we do have the MSCI adjustment, which will come into play today. A lot of the auto stocks are moving around on the back of that. Auto-related companies. So you have Escorts, of course, which is there. You have JBM Auto, which is moving well. It's up around 4%. You also have something like a Ramkrishna Forging. So these are few of the names, which are moving around quite well. Metals, of course, continue to be the big loser, like we have been talking about. Once again, sharp cuts seen on the index. These are some of the smaller names in addition to the large caps, which are, of course, under pressure. What's doing well today are some of the AC makers, right? So we spoke to Blue Star this morning. They're sounding very positive on demand. These are the kinds of moves that you've seen on a lot of these white good players. So they're saying that they expect 30% growth on a year-on-year basis. That's for this summer season. We have been talking about the early onset of the summer season. So all of these companies in focus on the back of that. In terms of Qs, there's not much really, but we do have the Q3 GDP data that will come out, as well as the auto sales will start tomorrow. So maybe we can expect some kind of, news flow in at least the auto pack going forward. But let's start now by talking about all of these individual names. Indiabulls Real Estate is one stock which is under pressure. It's down over 5% following some key leadership changes. So Nimesh is here to bring us up to speed with the latest. Nimesh?
Hi, Pavitra. So the stock is down 5%. I'm surprised, the market has taken this news negatively. But first for the news, the company has announced that there has been a change of management at the top end. So the current MD has resigned, which is Mehul Johnson, and he'll be replaced by Sachin Shah, who will be the ED for the next 5 years. Apart from that, additionally, they have also appointed 3 independent directors on the board for the period of 3 years. Now, to read this, it effectively means that there will be further control in the hands of Embassy. Remember, Embassy and Indiabulls Housing, Indiabulls Real Estate is looking to merge, and that NCLT order is pending. The next NCLT hearing for this merger is scheduled for tomorrow, which is March 1st. So that will be important to track. But in the fresh development, there's been a change of guard in terms of top management. The current MD resigns, and most of the new board is largely appointed by Embassy. So the control goes largely in favor of Embassy going forward, and the next trigger will be the NCLT approval for the merger.
Oh, thank you very much for that, Nimesh. Let's talk a bit about Cipla. The US FDA, remember, has issued several observations to its Pithampur facility. Ekta has accessed that Form 483, and she's here with the details. Ekta.
Hi, thanks for that. Well, yes, Cipla is in focus because we did manage to access that Form 483, which is issued to their Indore facility or Pithampur facility was inspected from the 6th of Feb to up to the 17th of February and was issued 8 observations. Now, when the number of observations itself came out, the stock had reacted quite negatively because the street had indicated that maybe the large number of observations would be indicative of the fact that they would not be able to resolve these observations in time to get approval for key drugs such as Advair generic, which is an inhaler drug, which is filed from this particular facility. Now, looking at the observations themselves, and a lot of the analysts have already gone through it and have come out with their initial thoughts on it, they have indicated that it looks probably a little more difficult for Cipla to resolve. Some of the brokerages have not even ruled out an official action indicated status, which basically means that there could be a delay in terms of approvals. Overall, this particular plant also is around 15% of the EBITDA for Cipla, and hence it is critical besides just new products being filed from it. And hence the inhaler Advair generic, which is expected in the market by Q1 of FY24, could probably now see a delay because of these 8 observations. Let's see, we will probably hear from the US FDA 3 months into the inspection, from the time the inspection occurs, to understand what kind of status will eventually be issued on the facility.
Okay, got that. So Cipla in the spotlight as well, Ekta. Thank you for the details over there. Let's move to another stock, and this one's quite interesting. Vedanta has fallen 8% in today's trading action. Lots of momentum on the downside. What's plaguing it? Nigel's here, and this one's turning out to be quite the corporate pot boiler, Nigel. The history, the past and the present. But tell us, what's today's trigger? Why is Vedanta falling?
Well, if you go by history, they'll wriggle out of it. You know, that's the way the Vedanta group has moved over the last few years. The problem is, the fear is that Vedanta Resources, not Vedanta Limited, but the parent entity, Vedanta Resources, if you're tracking the bond yields out there, they have moved up to around 35 to around 40% plus as well. So the fear is there could be a default at the promoter level, which is more than $7 billion odd, and they have some payments that are coming up in the next couple of years. So because of that, the listed entity, that's Vedanta Limited, is under some pressure. What's the relation? Well, let's pull up the promoter holding in both the listed entities. That's Vedanta and Hindustan Zinc. Now, in both these two entities, if you look at it, out of the total promoter holding, bulk of it is pledged. For Vedanta Limited, close to around 100% has been pledged. For Hindustan Zinc, close to around 88%. I think at some point of time that data point should come up for you. Yes, that's up for you on the screen. And, everything was going well for them. Unfortunately, what happened for the group was they had proposed this transaction when Hindustan Zinc will go ahead and buy Vedanta's international zinc assets for around $3 billion odd. But as we've been covering here on CNBC-TV18, the government of India has gone ahead and opposed this particular transaction. So because of that, that's put a spanner in their works, because otherwise, if Vedanta Limited sold that international zinc business asset to Hindustan Zinc, they would get money, and in turn, they would pay out a big dividend, which the promoter entity would get some money, and they could, take care of their debt as well. Now that has gone into a question mark. So how do they come up with the money? That's the question the street is working with. Remember, in Hindustan Zinc, that's the cash cow for them. Vedanta Limited has close to around 65% stake, and the government of India has around 30% stake. So can they come up with a counter proposal? How do they get some cash into their books, pay out a dividend in Vedanta Limited, and wriggle out of this? For the time being, the street fears that the Vedanta promoter entity, that's Vedanta Resources, could default on the debt, and that's why the bond yields have moved up, and that's reflected in the Vedanta Limited stock price here on the exchanges.
Okay, Nigel, got that. Thanks very much. Saving grace, I guess, just to add, is that this debt is coming up for repayment, not immediately in the next 3-4 months, but the bulk of it, the big ones, are coming up for repayment in 2024. So some more breathing room for them to figure out a way around this. With that, let's take a very quick break. We'll come up on the other side and discuss everything that's buzzing in the commodity space. Manisha Gupta will be joining in. Back here with us on Trading Hour. Flat as flat can be in the equity market. Let's figure out what's making headlines in commodities. We've got Manisha joining in. Manisha, focusing on aluminum today. What's happening?
Well, yes. So we thank you for that. Yes, aluminum prices, it should have really run up because the markets have seen the US impose 200% tariff on aluminum and derivatives that is being produced in Russia. But we clearly have seen that being shrugged off. One, you still have to see that happen. The sentiment impact is absolutely not there. And what the US has done is that from 10th of March, all the Russian-produced aluminum and inventory and derivatives are now going to be banned from US. And from 10th of April, even there will be 200% tariff on aluminum imports in sense of alloys and other derivatives as well. So what the markets really look at is that Russia, as of now, while it accounts for 6% of global aluminum availability, but the US imports in any case have been declining, and the other countries clearly have not banned it. And we have seen a lot of aluminum come on the LME exchanges as well. So when it comes to Europe and Asia, these countries have not banned Russian aluminum, and the imports clearly would come in from there. The chart should tell you on what kind of imports US has been doing. It has been constantly declining, by the way. In 2017, all of import of aluminum that US was doing, 14% of that was coming in from Russia. It declined to 9% in 2018. And in last year, it was just about 4.4%. So that is what US is trying to get away with, not a very strong number. In the meanwhile, we already have seen China 2022 production gain up by 4.5%, which has been at an all-time highs. So this move, even as it is 200% of a tariff on aluminum imports of Russia into US, has not impacted the markets as of now. It still is going to be about China and the kind of demand that we see from there. Markets also are looking at the Europe import and demand that seems to be now getting better, which seems to be supporting the aluminum prices as of now.
All right, Manisha, thanks a lot for getting us all of those details. We do have to get into a short break now, but when we come back, we're going to discuss the market technicals. Mitesh Thakkar will be with us. Hey guys, welcome back. You're still tuned into Trading Hour. Very quiet for the markets like we have been telling you, but for now, we're looking at a near 20% cut, 20-point cut that we're seeing on the Nifty. It is the mid-cap index, which is seeing a little bit of green. That has moved up a little bit in the past few minutes as well. So that is currently 0.4% higher. From the larger stocks, what's doing well, like we told you, is the Adani Group stocks. So you have Adani Enterprises and Ports, which are doing well, but a bunch of the auto names as well. So whether it's in M&M, you have Bajaj Auto, Tata Motors. Remember, the sales figures will come through tomorrow. So ahead of that, they're holding up quite well. Bajaj, of course, also saw a big cut yesterday, so it's recovering some of that ground, but very quiet on an index level for what's happening with the market. So let's get you a technical check now. Mitesh Thakkar joins us for exactly that. Mitesh, good morning. You know, yesterday we broke below the budget day low. We broke below the 200-day moving average, but we did see a little bit of a recovery. How do you look at the markets today when it's absolutely quiet? And also the Nifty Bank was a little bit more resilient yesterday, right? Your call on the Nifty Bank as well?
So I think yesterday, while we did trade below the 200 average, we didn't get a closing below that. And I was hoping that if yesterday's low holds, then we'll get a reversal. So we still haven't breached yesterday's intraday low, which on the Nifty is about 17,299 or 17,300 as a round number. We also are not getting a signal of reversal. One, we are very oversold, and two, we are trading close to support areas. So I think just wait for some kind of reversal signal on the intraday charts. And then when it comes, I think, which could be a move beyond 17,450, then I think we might see a stronger pullback to about 17,600, 650 zone. So I think for the time being, we have taken profits in short positions, but waiting for some kind of reversal signal on the upside to possibly explore long positions. So it's slightly a wait and watch kind of a mode, and that's why the market, if you notice, is also very subdued and sideways. I think once a move above 17,450 happens, then I think you will see momentum come into the market on the upside. Otherwise, just wait and watch. On the stock side, I have one buy and one sell. Coal India is breaking down, so that's a sell with a stop at 215.5 for targets of 205. And Crompton, on the other hand, is reversing from oversold levels. So that's a buy with the stop at 301 and a target of 18,319 on the upside.
Mitesh, you gave us the levels on the way up. That if 17,450 is breached in the way up, then you see momentum building up and it makes sense to go long. What about on the way down? A breach of what level will convince you that markets are headed lower?
So, I think, as I mentioned, I think yesterday's low becomes very important. One, because as I said, we are very oversold and we are trading close to support areas. And yesterday we had made a low of just around 17,300. So if that gets, if that level gets taken out, then I think we'll explore some kind of shorting with put options at least.
Thank you very much for joining in. So for now, it's a bit of a wait and watch approach at the index level, 17,300. Yesterday's intraday low is an important support, but on the way up, a breach of 17,450 is important to get the conviction to go long. But let's talk about the MSCI index adjustments, which come into effect from today. Vivek is here with the details. Vivek.
Well, that's right. So
The MSCI adjustments will happen in today's trading session. These announcements were made earlier in terms of the inclusions and the exclusions. So which are the stocks, that will be impacted in today's trading session? First, we have two inclusions into the MSCI Global Standard Index. So Bank of Baroda and CG Power will make their entry. Bank of Baroda expected to see flows of a little over $130 million, while CG Power will see flows of close to $150 million. On the other hand, Biocon is expected to see outflows of around $80 million on the back of the fact that it is being excluded from the MSCI Global Standard Index. The other group of stocks, that will remain in focus are the Adani Group stocks. Now, remember, when it comes to the Adani Group stocks, MSCI has gone ahead and reduced the weightage in Adani Enterprises. They had earlier reduced the weightage in two other stocks, that is Adani Total and Adani Transmission. However, due to the stocks continuously hitting lower circuits, they have postponed this particular adjustment to the May review. Apart from these, there have been 24 additions and 5 deletions that have been made to the MSCI small cap index, and all of these changes will come into effect in the last hour of today's trading session.
And several of those stocks are bouncing around. Thank you, Vivek, very much for all of the details there. So that's the MSCI index changes and how they're impacting stocks today. Let's move on to some interesting corporate commentary. Now, as the IMD issues warnings of the first heat wave of the year in March itself, this news of an early summer has been quite a positive for air conditioner and cooler manufacturers. Blue Star today surged about 16%. Not today, actually, over the last 1 month has surged about 16%. We caught up with the management, B. Thiagarajan, MD of Blue Star, to discuss their targets for not just the current year that's going to be wrapping soon, but the next one. The management has struck a pretty optimistic note on sales growth, given the intense summer expected ahead.
The target is to touch $1 billion revenue. And in the room air conditioners, for the first time, we would cross 8 lakh numbers. Next year, we are planning to cross around 1 million numbers. That's the plan.
That's the guidance from Blue Star. Get into a break. On the other side, we'll discuss market fundamentals. Nilesh Shetty of Quantum Advisors. Welcome back. So quiet for the markets. Let's invite Nilesh Shetty, Portfolio Manager at Quantum Securities, on the show now. Nilesh, they say that the best time to accumulate stocks is when the consensus perhaps is not very optimistic and not very bullish about big returns. We've gone through a long period of consolidation. In fact, since October and the highs that we hit in October, the Nifty is down more than 5%. The small caps and the mid caps have corrected and seen a double-digit correction. So now perhaps is a good time to go ahead and accumulate. What are the stocks on your buy list? And can you give us your top 2, top 3 stock recommendations?
Yeah, I may not be able to speak on stocks since we're a portfolio management company, Quantum Advisors. But that is correct. There is significant value in the market. The 5% correction is not much given the rally that has unfolded post the COVID bottom. But there are sectors available with substantial discounts to their long-term averages. The biggest of them remains BFSI. So banking sector has underperformed significantly in the rally. And you see private sector banks, they are still far below where they were trading pre-COVID in terms of long-term valuations. So we do have a large allocation there. The two-wheeler space again remains a deep value sector, which because of certain regulatory changes, volumes are where what they were reporting 10 years ago. It's not that two-wheeler demand is collapsing in India. It's just that market is or the demand is getting used to the new price levels, and it will turn around at some point. And some of the fancy sectors of sort of 3-4 years ago, which now nobody wants to look at, including insurance and broking, you are seeing stocks available at deep discounts there. We are sort of looking to add stocks from these sectors to our portfolio.
That's an interesting one, Nilesh. Insurance. So you're looking to, pick up bargains, considering that the market's quite disenchanted with these stocks. So is it life insurers, or are you also looking at general? And since we're on the subject, I just wanted to get your thoughts on, this whole motor insurance move. There's some chatter that perhaps the government could look at issuing policies, on the spot, at least third-party motor policies. Could this be a big kicker for companies? I mean, there's only one big listed play that we're talking about in the general insurance space. But your thoughts?
Yeah, I mean, whatever regulatory changes are happening and may happen in the future, the structural story is that Indians remain underinsured is not changed. And there is a big catch-up due as we evolve. So there is no doubt, nobody doubts that the insurance sector will grow. It is what kind of valuations do you want to pay for that growth. So a few years ago, people were willing to pay the sky for these companies. Unfortunately, they've been disappointed, and now they're available at deep discounts to those valuations. We think current valuations are fair. We think there is significant value. If you're patient, I think especially on the life insurance side, the fact that they were being sold as savings product and not as insurance products, that shift is now happening, where people will eventually start buying it for insurance. And the world over, people buy it for insurance. They don't buy it for savings. So it's not that Indians will not buy life insurance products purely for insurance. So at a certain valuation, I think both the sectors, life insurance as well as general insurance, make sense. Existing listed companies, and I expect a lot more companies to come through in this space. It's a very competitive sector. Most of the companies are in the not listed space, but they will come through. I think there are an interesting lineup of companies due for listing, and I think that space will get broader, and you will get decent companies at valuations that you're comfortable.
All right, that is on insurance. Nilesh, thanks for joining us. This is Pavitra. What is your call on the metal space now? You know, we're talking about an over 20% kind of cut for the year. Would you look at any of these stocks at these lower levels, or you think it's still a complete avoid?
I mean, metals had a fantastic rally post the COVID bottom, and typically these stocks tend to do well for a couple of years, and then you have 4-5 years of downturn. Our sense is that peak has already been hit in the commodity space, unless something dramatically happens over the next 1-2 years. I think allocating more capital perhaps is not advised. So the valuations still not, so they've corrected, but not as much as they should, assuming there is a recession in the West. So there is no value as such in the space. But if you see companies starting trading at deep discounts to their book value or replacement cost, then they get interesting. You might have to buy and wait for the next upcycle to come through. But right now, they are somewhere in between in terms of valuation. So there is no great value for an investor to buy and wait for the upcycle, which may happen in the next 3-4 years later.
Nilesh, pharmaceutical sector and healthcare has seen a deep correction. The earnings have not been great. Many of the companies have been hit on account of pricing pressure in the United States. At what point do these stocks appear attractive to you, or do you think they're in for further correction? How would you approach the healthcare space?
Yeah, some of the stocks appear that the worst is already factored in. But like I said, there is no near-term catalyst available in these stocks. You might have a couple of years of painful period where you will have to wait it out. But if you're able to buy a quality company and then have the patience to wait it out for the next couple of years, you still might be able to make your long-term average returns in these stocks. But like I said, just the lack of catalyst in the near term is what is sort of
Healthcare in India is diagnostics, it's hospitals, it's the generic companies. In which pocket do you think the worst is over?
Yeah, we primarily focus on the pharmaceutical space. The other sectors, diagnostics and hospitals, they've always been priced for the moon. So in a value style, we've never been able to justify their valuations. Diagnostics has gone through a significant correction, but still valuations remain very, very elevated. And there is significant competition coming in that space. So at least for us, we've had allocation to pure pharmaceutical companies and not so much in the other healthcare bucket.
Okay, all right, Nilesh, we will leave it on that note for today. Thank you very much for joining in. Great chatting with you as always. We'll look forward to the next one. Well, with that, we will, get into a break. Before we do that, let's just quickly check. There is a bit of a down move right now that's visible on the screens. 35 points down. That's about 0.2%. Look at the movers and shakers. Again, the names pretty much remain the same. You've got a lot of the commodity stocks like Coal India, Hindalco. These are stocks on the way down. ONGC, Tata Steel. So the entire commodity universe basically is taking this market lower. And then you have Reliance. And when Reliance is down, we know what that means. So that's the shape of the market, at least as of now. With that, here is some more corporate conversation, some more corporate commentary. HCL Tech is in focus after the company launched 2 technology solutions for the 5G ecosystem at the Mobile World Congress 2023, which is underway in Barcelona. In fact, earlier in the day, the company's MD and CEO, C. Vijay Kumar, spoke to CNBC about the deal pipeline and the outlook for the company's revenue as well as margins. Take a look.
In terms of our pipeline, it's probably the highest that we've ever had. For example, today we have, it's expected 150 $50 billion of vendor consolidation opportunities are in the anvil in the next 30 months. So providers who have a broad breadth of capabilities like us, we are the leaders, we're the only leader in all the 6 magic quadrants of Gartner IT services. And we have the breadth of service offerings, which will really play into these vendor consolidation opportunities. Over the last 5 years, we've doubled our revenue, and the outlook remains promising. And I do think we have an opportunity to double in the next 5 years. The margins have been stable. I think barring the last couple of years when the wage inflation was a big headwind in our margin trajectory. Barring that, it has been stable, and given a little bit of moderation on the wage inflation, we think our margins will improve. We are 18 to 19% operating profits. And we think we used to be in the 19 to 20, even a little higher than 20. We think we will inch up there in the next few quarters.
All right, that is a very positive HCL Tech telling us that margins will get back to 20% kind of levels, and the deal pipeline is the best that they've ever had. We are going to get into a short break on that note, but there's lots more market action coming up for you in just a bit.
Welcome back here with us on Trading Hour, and we are looking at a couple of stocks in focus. Some of them are quite on the move, and Z manages to find its way to that list over the past couple of days. Today is no exception. The stock has been moving higher, almost 5 to 6% higher in trade, as the exclusion of the stock from the F&O segment, at least for now, stands withdrawn by the exchanges. Let's bring in Vivek. Vivek, I guess this has something to do with, what transpired at the NCLAT just a couple of days back, right?
Well, absolutely right. So, once the company was admitted into NCLT, there were 2 updates that happened as far as Z is concerned. Number one, what the exchanges said was that, it'll be excluded from the F&O derivative segment from the May series onwards. So, current contract and 2 months forward contract were allowed to trade. And the second thing, which actually impeded the volumes a lot higher was the fact that 100% upfront margin was required to trade as far as Z contracts or Z futures were concerned. However, after the relief that the company has received from the NCLAT, that particular order stands withdrawn. So, you can now trade in the May futures as well. And secondly, 100% upfront margin is no longer required. So, on the back of that, it's a technical positive as far as Z is concerned, but the stock is clearly cheering this particular move.
All right, Vivek, thanks a lot for taking us through the details there. With that, it's time for a short break. But when we come back, we're going to talk all about the markets. We'll have Sunil Thirumalai of UBS joining us for a quick chat. Hey, guys, welcome back. You're still tuned into Trading Hour. Let's get you a very special conversation going now. Sunil Thirumalai is Executive Director and India Strategist at UBS. He joins us now to take some questions on the markets and what we could see from here on. Sunil, thanks a lot for joining us as always. This is Pavitra. With the Q3 earnings season done, we have been talking about the slew of downgrades that have come through, especially if you remove the financials performance, it's looked quite weak. I do know that you expect significant earnings moderation from here as well. Can you take us through how much more you expect from the kind of levels that we've seen? And then in turn, what will that mean for the Nifty EPS going forward?
Thank you very much. And, hope all your viewers are safe and healthy. Yes, so if you look at the Q3 earnings and actually look at 2Q and 3Q earnings, because that gives us a good picture of the balance sheet as well. I think there were a few worrying trends that stood out for us. On the balance sheet, it's our working capital for the, let's say, the top 200 non-financial stocks is almost at a 7-8 year high, right? And there are telltale signs that this is not only because of inflation. It almost seems like for the large corporates, their terms and conditions of what was their supply chain has actually generally deteriorated over the last 5 years. And leverage is going up again, not only because of inflation impacting margins, but when I say leverage, I'm talking about net debt to EBITDA, but also because the numerator, right, the net debt is also going up. If you look at the earnings per se, the P&L, etc., I think it's good that inflationary pressures are coming off. And that's kind of helping. I think the margin outlook because of that should be good. But all said and done, we are still seeing very sticky, elevated levels of other costs like SG&A, employee costs, etc. All in all, it almost seems like either from a pre-pandemic level to now, there seems to be anywhere from 100 to 150 basis point upward reset of these costs as a percentage of sales. And which means that even if raw material costs basically normalize, this is something which I'm a bit worried about and struggling with, right? So basically, yeah. So that basically means that from a pre-pandemic position to now, we are talking about the quality of earnings being slightly weaker, right, across all these metrics. So yeah, I think the thing about sell-side consensus estimates is that you normally start higher and start see cuts all through the year. So I would look past that. I think the markets are used to that. Once you adjust for that, my sense is probably are looking at about 6 to 8% lower EPS for the Nifty. As you rightly said, I think a lot of those cuts are actually happening, but it's not visible on the Nifty headline number because of the banks holding it up very well because of the margins expansion. But that could also reverse, right? We are
so Sunil, just to understand the numbers, right? When you say that you're expecting 6 to 7% cut on the Nifty EPS estimate, is that X of banks, or are you saying even with the banks helping, the downgrade season has just started? Because I think this quarter, at the end of Q3, downgrades are in the range of 1 to 1.5%. Are you saying there's another 5% to go?
So yes, I think you had my banks analyst colleague Vishal last week, and clearly our view is that the banks downgrades could be ahead of us in the sense that the margins expansion that fueled earning surprises from the banks could be coming to an end because now the costs for the banks are now beginning to go up, i.e. the deposit rates are beginning to go up. So at least the support that, so if you look at the Nifty, the 50 stocks in the Nifty, close to 28 stocks have seen earnings cuts in the last 3 months, right? But still the Nifty hasn't seen such a big cut because banks have been holding it up. Now, if the support from banks goes away, you will actually see a lot of those earnings cuts actually close.
Got that. Sunil, hi, Rima here. So one factor which will drive earnings downgrades from here on will be NIM-related compression at the banking stocks, right? That's one factor. What else? What are the other trends that you see which will drive earnings cuts from here on? You spoke about what happened in the last 2 quarters about working capital conditions deteriorating, sticky SG&A. But can you talk about FY24 and what will drive the earnings downgrades?
So yeah, so in addition to banks, globally we are a bit cautious on commodities, right? And when you see earnings cuts or increases in commodities, even though their weight in the index may not be too big, the magnitude of changes can be large enough to actually move the needle on the index. And I think in general, I would say there is a lot of narrative in the market on rural slowdown and when will the rural recovery happen. I'm not really a big fan of that narrative. I don't know if there is a general widespread rural slowdown. There are companies and sectors which are doing well even if they have a rural exposure, right? But it almost seems like the market is hoping for a big revival from rural demand. I mean, that might be very sector specific, company specific. And yeah, I mean, in fact, if you're talking about some of the weaknesses that are visible, in demand, then you could see that across a whole bunch of consumer-facing stocks as well.
So what does that imply, Sunil? I mean, you're saying that you're not quite with the market narrative of this rural slowdown. So if there's no slowdown, then don't expect a big revival. Is that what you're saying? That's another than sort of bearish sign for times to come.
That's correct, yes. So, I mean, because the rural slowdown narrative has been built in by 2 or 3 consumer companies. But I don't think that's, if you actually listen to a broader, sample of companies, it's not really, such a widespread problem. I mean, there are consumer-facing companies who are actually doing reasonably okay, even if they're looking at rural. So it seems more like a rich versus poor kind of a problem rather than a rural versus urban kind of a problem. And it just so happens that there may be more, lower income people in rural areas, right? So yeah, I mean, I think I wouldn't bank on a massive rural revival. I mean,
one number answer, Sunil. What is the FY24 EPS growth that you expect?
So I think for so FY24 we are probably at about 9 to 10% earnings growth.
Got it. But I believe consensus is closer to 14-15%. So that's the extent of downgrades we could see. Sunil, great conversation. Thank you very much for joining in. So the earnings downgrade perhaps has just gotten started, and it will pick up through the course of FY24. It's a wrap on Trading Hour from the entire team. Thank you for watching.